This is your market update for February of 2016. Market was very volatile this month, although we ended up relatively flat. The S&P 500 was down 3.7% midway through the month, and we ended down 0.13% for the month and down 5% roughly for the year. International stocks, much of the same. Mid-month, we were down over 5% for the MSCI World. Ended up down 63 basis points for the month, and they're still down 6.5% for the year. Much the same in the bond market. We continue to see strength in particularly the 10-year U.S. Treasury and longer on the Treasury rate curve. The Barclays Global Aggregate was up 71 basis points for the month, and international bonds were up roughly 2%. So we've seen some real strength in the bond market as global investors kind of make a flight to safety in long-term treasuries based on the strength of the U.S. dollar and the relative health of our economy versus the rest of the world. For a quick global outlook, the U.S. continues to be a leader globally in what's becoming a more and more uncertain world. Two of the kind of leading indicators that let us think that we're going to have more volatility going forward are China, as they continue to work through problems with their currency as their growth slows. China continues to burn through roughly $100 billion worth of reserves a month. That can't continue. They're going to need to slow that pace down. If China can slow that pace down, that's going to go a long way to promoting further global economic health. If you continue to see those reserves burn at that high of a clip, we're probably going to continue to see some extreme volatility in several days like we saw earlier in February month, where you just have global asset prices down across the board, including commodities like energy. The other issue we have is we now have several governments, particularly developed markets like Japan, running negative interest rates. What negative interest rates are, they're kind of funny to think about, but you have a government that's disincentivizing you from saving to the point where you literally don't want to keep your money in a bank because or buy government bonds with it because you're paying them for the right to hold your money. That kind of makes your head hurt thinking about that, but that's what's going on, and what they want you to do is go out and spend that money and invest in asset prices. This is kind of problematic because it's symptomatic of the fact that we have relatively anemic global growth in developed markets, coupled with growing debt burdens to where you have to run negative interest rates in order to keep things moving forward and hopefully generate some inflation. What that tells us is that going forward, we're going to continue to have volatility globally, and it's going to spill over here. Even though the U.S. economy looks relatively good, we have good employment, wage growth is looking good, everything's kind of chugging along, and which leads us to believe the Fed is probably going to raise rates again sometime in the next, probably in March, but by summer we would think. And that's going to continue to kind of cause some disturbances in the market. But the U.S. continues to be the global leader, and we would expect that to continue.